Hello, everyone, and welcome to this short session. I've actually started it just as Jay Powell has started his press conference, as we've just had the FOMC, and in fact, it's the purpose of this session. I just want to look at a little bit more closely at what the Fed is up to, what this decision, what the implications are for the markets with regard to this decision, and also look at some charts and see where perhaps we can spot some nice VPA traps. But before we start, can I just draw your attention to the disclaimer that I know you can see on your screen? As you know, trading can be a very risky business, so please don't ever think of using money that you cannot afford to lose. So let me just take the disclaimer away and pull up my charts and my tabs of some resources that I want to share with you. I'm a little bit late to this session. I do apologize. I was hoping to have started earlier, but had a little bit of some technical problems. But I can still go through the resources because you can use them the next time. With regard to Jay Powell himself, what I always suggest at these events is find yourself a live feed. You can you'll either find it directly here, as we can see here, at the Federal Reserve, but it's also, as you can see, it's on YouTube. And it's really interesting to have the live press conference somewhere on your screen and simultaneously look at the price action. I would suggest you look at the price action either on one of the risk assets. If you're a forex trader, by all means have a look at some of the risk currency pairs, and obviously the US dollar. But I've actually got the futures, the ES futures, which is the E-mini futures for the S&P 500. I've also got the VIX up as well, and so there he is. He will be taking questions from the journalists. What I also would suggest is have a feed, have a really good up-to-date feed. I have Financial Juice. Those of you who have watched some of my videos in the past will know that I've featured this feed. They have a free version, but it is slightly delayed. You know, if it's not Financial Juice, you know, find one that suits you. These guys are really good. You know, you do get the most up-to-date points of what he is saying. It almost comes out simultaneously. And then what you try and do is match what, you know, are there certain keywords coming through to what he's saying? How are they impacting what is, you know, what is actually happening on the chart? And as you can see here, he talks about evidence. You'll find a lot of what he says is going to be about data. Everything's going to be data dependent, which is obvious. They're not going to make a decision without data, and it's that data which is going to determine what they are going to do in terms of raising interest rates moving forward into 2023. While that's scrolling through in background, unfortunately, I've only got one screen here, so I can't have it, you know, looking at it simultaneously. So I will come back to it occasionally. But having a quick look at what the forex market is saying, and you know, the opinion. I've got here our currency strength indicator. I've actually got it on the 5-minute chart. We've got the dollar. The dollar, you know, it went down. Now it's you know, going up. You can almost say that if the dollar's being sold, then the market likes it. If the dollar is being bought, then you know, the market doesn't really like it. That's how, you know, the dollar tends to move with relative to the, you know, equities and stocks in general. You can also hop over to investing.com. And there you can have a sort of summary of what all the indices are doing. And we can see here the Dow, that was around minus 300 and something before the FOMC decision. It gained a little bit, and now, you know, just see the numbers ticking through. That's the they're the futures. That's the actual Dow Jones. That's the S&P, that's the S&P 500, and that's the future, sorry, and obviously that's the NASDAQ. But it's the VIX you also need to keep an eye on. And crucially, obviously, look at bond yields, because bond yields, if they start going down, the market is, you know, it's happy. It's going to be assumed that, you know, it's going to be risk off. If they start rising and rising sharply, they don't move hugely, but if they do start going in north, as it were, you know, the market isn't you know, isn't going to be very happy, as it were. So everything is here on, as I said, at investing.com. Now, if I have a look at what the ES has been doing, which, as I said, is the E-mini futures for the S&P 500, I've actually got my TradingView account up for this session. And the way I've organized these charts is I have different time frames, and I also have split out some of our indicators rather than have them all on one chart. So, for example, on the first chart, I have the volume point of control. I have obviously volume. I have the volatility indicator, which is these little purple arrows. These fire off in real time when the price action is outside of the average true range for this particular time frame. And as we can see here clearly, there has been volatility. You know, in fact, we had a first volatility candle 5 minutes before the actual announcement itself, which was at 7 o'clock our time, 2 o'clock Eastern time. That actually fired off, and in fact, what happened? The market shot up on very, you know, less than average volume, as it were, and then immediately came down. You know, that's a typical trap move. Maybe scalping traders would have said, oh great, so it's going up, then it's going to go down. It did go down on the subsequent candles we can see here, but essentially what we're seeing is we saw a lot of whipsawing at the actual release itself. The press conference is going on at the moment, and we're not seeing huge volatility. Well, certainly not in comparison to what we saw when the announcement was made that it was a 25 basis point rise in interest rates. And I don't know why, in a sense, what, you know, this volatility you know, came into the market, because one of the resources that I want to mention to you today is at the CME, and it's called the Fed Watch tool. And what that does is it takes a poll, and it tells us what the market is thinking, what percentage of participants, you know, do they, you know, what is the increase likely to be. And we can see here that the Fed funds rate was always going to, you know, 98%, almost 100% were convinced, and they've been proved correct, that it was going to be 25 basis points. So it moves the Fed funds rate between 450 and 475. It was 100%. The Fed would have had to come in with something extraordinary to create that kind of volatility. But it's just the way of the market. We can see here now we are getting a little bit more volatility. We can see from the price action, not as much, you know, the volume certainly hasn't, you know, it's not been an inrush of volume, so it is purely on price action alone. Now, getting back to this TradingView workspace that I've got, as I said, I've split out some of the indicators. So I've got the volume point of control on this one. This gives me where the volume point of control is itself, which will then act as both support and resistance. And I've got the outer limits of the VPOC. This is just the 5-minute chart. But what I've put here on the next chart is I've actually put my Camarilla levels. I've taken everything else off because these pivot levels are really, really important. And what they tell us is if this is going to, if the market is not going to be happy with what Powell is saying in his press conference, he is going to, yes, there's only been 25% basis point increase. And no, we're not going to pause. We are going to be data dependent, even if that data is, moderating in terms of inflation. I'm still a hawk. I'm going to do whatever it takes to bring inflation down to this 2% level. I have to say, up until now, the market has been extremely skeptical about whether the Fed is, it talks tough, or the, certain members of the Fed talk tough, but there's not always the sort of the follow through. If you really wanted to get inflation under control, maybe the rates would have been more aggressive than they are at the moment. But then the Fed's situation is it's stuck between a rock and a hard place, because if it's too aggressive, then you're going to you are really going to trash the economy. People are talking there is a recession coming anyway, and it's just a question of how severe that recession is likely to be. So, but what the pivot levels tell us, they are pretty reliable, even when you have a volatile session as we have at the moment. The S4 is important, not quite as important as possibly the S3, but these are the two most significant levels based on the Camarilla protocol. So that's what I've got there. What I have here, I then have the hourly chart, because as always, we should be looking at multiple time frames. And what's interesting we're seeing here is, as this is going lower, we're coming down to the S3, which is around the 4,000 level. That's a hugely important level for the ES. To return to, while this is going on in background, and and the market decides whether it likes what he's saying or doesn't like what he is saying, another resource which you may find extremely interesting and useful, and it doesn't really matter what you trade, whether you're a foreign exchange trader, whether you are stocks, whether you're indices, and that is to really understand who the members of the committee, who are the current members of the committee, but more importantly, where they fall in what they call the hawk-dove scale. What essentially that means is it's a scale that at one end of the extreme, you are very tough, you're very aggressive, you take a certain view of monetary policy. So, for example, when it comes to interest rates, you're going to say, no, it's inflation, we're in danger of inflation. You're going to go in really hard with regard to raising interest rates. If you're on a dove on the other end of the scale, then you're much more into taking a much softer approach. That's really the best way I can describe it. I don't want to go into the economics of explaining the monetary, the philosophy behind the monetary policy, but just take it that if you're a hawk, you're going to be very tough on things like inflation, you're going to come down hard, whereas if you're a dove, you're going to take a softer approach, much keener to soften the blow, possibly by continuing with QE, bond buying, pushing liquidity into the market. It's monetary policy, even economics. It's full of mathematics and statistics, as we all know. But actually, when it boils down to it, it's really a philosophy. And in fact, that's how it started. It's how you think an economy should be managed. It's very political. It's obviously tied to what you think, you believe politically. So we have to, sometimes we forget that, and we look at data, we look at releases, and we think mathematics has got the answer and statistics have got the answer to everything. Well, it doesn't, because it does have, at its core, it is a philosophy. It's a belief system in how you think an economy should be managed, and more importantly, when things go wrong and are going wrong, what do you do next? What is the best way to restore it to health? So understanding who is on the committee at the moment when these decisions are being taken is really important. And if we look at who's who at the moment, we can see that, I suppose you could say that there is a tilt at the FOMC at the moment to more towards the hawkish side, to taking these tough decisions about inflation, curing it, if you like, with aggressive interest rates. But we all know, if interest rates are too high, then no one's going to borrow anything. It's going to cause a problem for companies, on a personal level, mortgages, credit cards, etc., etc. What is also interesting is who actually gets to vote, because if you don't have a vote, then obviously the chair is going to listen to your opinion, as are all your colleagues. But at the end of the day, if you don't have a vote on what decision is going to be taken, it's awfully interesting. And for this, on this occasion, at the moment in 2023, Bullard, who has always been considered to be the most hawkish, and Mester, they don't actually have votes. So, as I said, although on one level it seems very simple, you have a hawk-dove scale, but there's much more nuance to it. What's also interesting is that Lael Brainard has been sort of touted for a new political position at the White House, for, I think it's the head of what they call the National Economic Council, but no decision has been made. She's actually the vice chair. You could say she's an Uber dove. If she goes, then the Fed is in a bit of a tricky position, because it takes quite a long time to find a replacement, and these are very tough, very difficult times, and you really want the Fed to be discussing these important, taking these important decisions about who's going to be on the committee, when I would imagine you would want a well-established body of people who kind of understand each other. But anyway, that's just my opinion. So that is what this is where we are at the moment with regard to the FOMC. I believe this has been kept up to date. It's from ITC Markets. They really do a fantastic job. There's also one for the Bank of England, and also one for the ECB, for those of you who are forex traders. Now, the other bit of information that I wanted to give you today, hopefully I have got it here. No, he's still speaking. Hopefully I have brought it over. Doesn't know, I'm going to have to find it. But what I came across was a really interesting article. It was the history of all the past Fed chairs, and how successful they may or may not have been, what the returns. So I'll start again. What the returns were for the stock market under their tenure, and it makes for fascinating reading. I don't think for some reason the tab has disappeared off my Google Chrome, but what I'll do is I will put the link in the description at the bottom of this video. Now, clearly, Mr. Powell has said something that the market likes. So we have had a complete reversal of sentiment. In fact, when I said earlier the price action of the ES was actually trading in the within the bounds of the volume point of control, these are the outer limits. This level here, 4048. We know there's buying coming in. I mean, VPA 101 doesn't go out of the window because prices are a little bit volatile. There's an event going on at the moment. If you look at that candle, yes, it's a volatile candle because of the range of the price action. But you have a nice wick to the bottom of that candle. You have a lot of volume underneath it. So what is that going to tell you? If the chances are the prices will actually move higher. And this big candle, that amount of volume, it's, I wouldn't say it's perfect, but there is a determination to move this market higher. And in fact, I did a post on, I think it was on my Facebook page, which is Anna Cooling Author at Facebook. And I actually laid out the reasons why this market, the markets generally, despite everything, despite inflation, despite the inversion of various bond yields, despite what's going on a geopolitical on the geopolitical stage. Obviously, we still have the war in Ukraine. We've had an energy crisis. Markets do not want to fall. And if we look at the daily charts, the weekly charts, we can actually see, they are holding up. It doesn't mean we don't have corrections. It doesn't mean we don't have pullbacks, which may or may not be tradable, but markets in general are not ready to fall dramatically. And it's sometimes when you listen to the financial media or even mainstream media, and everything is terrible. How can it seems like the world is ending, as it were, and yet the markets keep going higher. But as a trader, in a way, whether a market goes up, whether a market goes down, it doesn't really matter, because you just want to be on the right side of the market. For investors, I think it's a little bit more tricky, because whilst markets don't seem to want to fall, it is a difficult decision to commit to maybe a longer term investment, because at the same time, all these things that are in background, and we have earnings season at the moment, they are still a little bit fragile. That's what I'm trying to say. So for a trader, it's great. You just trade what you see on the screen and away you go. And we can see here, as I said, I've just got the 5-minute chart for the ES. It's pushing, it wants to push higher. If we go to let's have a look at our pivot levels, see where we are. And in fact, it's gone right up to the third level. That's a really important level. If it gets through there, where does it want to go? Well, R4 is the next logical level. Obviously, lots of volatilities we can see from the volatility indicator being triggered. But there's a lot of volume under these candles. They want to take this higher. If we go to the hourly chart, let's have a look here, compare what's going on there. And we're not quite that. You will get different values for the Camarilla on different time frames, because the way we've developed the indicator on the time frames below an hour, they are refreshed every day, whereas on the hourly chart, they stay in place for the rest of the week. So it's quite a good, it just gives you different levels to use for either as a price objective, you can use them for stops, and for support and resistance. So it would be interesting to see what happens with the, if it gets to the R3 on the hourly chart. And if we go back to the 5-minute chart, let's see if we've had a little pause at the R3 here. Well, this certainly hasn't got the momentum of these two previous candles. It does seem to have come to a little bit of a pause. Now, how do we know if this is going to be a reversal or just simply a pause? It's going to be going into congestion. Well, we're going to have to look at the volume. If we suddenly see a red candle, if it's not supported by volume, we know it's probably got a little bit further to go. With regard to if it's going higher, it carries on higher, it's still going to need volume to take it higher, and that's the next logical stopping point. I've got the VIX up as well. This is one, it's actually from one of the brokers. It may be slightly delayed, so I just happen to have this one on my platform. But going back to investing.com, what we have here is, where are we? There we are, the VIX here. It's down to 1854. You can bring it up, and it actually does have a chart as well. And it's very simple. As the S&P 500 goes up, or the ES, the VIX will fall. So it should be it's got an inverse correlation, if you like. And it's whether one leads and one follows, I couldn't possibly tell you. But if you do trade the indices, especially the ES or the actual cash market or the SPY, then you really do have to have the VIX. So if this continues to fall, we know that this is going higher. I mean, it's just that's the logic behind it. And what we want to see all the time is we want to see the volume going higher as well. We can go and catch up with Financial Juice and see what he says, what is Powell saying to encourage the market, if you like, to be positive. And you can, this is where you can pick up if you're not sure about what he's saying, or you've never listened to Powell speak, then if you go to somewhere like Financial Juice, they will explain it for you. Right, immediately my eye is taken to this metric here. This is the PCE. The Fed has certain statistics, certain metrics that they like to use for their decision making. One of them is called the PCE inflation measure, and you can find these on your economic calendars. I would also suggest that you find a couple of calendars to follow. If you're in Forex, and what we suggest with our Forex traders is to use Forex Factory, which is a great calendar. It classifies all the releases in terms of their potential impact on the market, but it's not comprehensive. You really need to go to somewhere like the economic calendar at Trading Economics. Now, this isn't today's calendar because I wanted to put so move that to yesterday. It's really important because there's an item, there's a data set on here which doesn't appear on Forex Factory, but it was really the reason why the markets went up yesterday afternoon. To return to Financial Juice, the PCE, he says the 3-month is actually quite low. They would like that. The market would like that. So that's good news for the market. The market will go up. There's also a political question here about the debt ceiling. That's kind of being kicked down, the can's been kicked down the road. That's not, we'll worry about that on another at another session. He talks about the terminal rate. The terminal rate is this rate that they have as, if you like, an end point for when interest rates can actually start to come down. It's the optimal rate. Sometimes it's called the neutral rate. Well, last September it was going to be, they thought it was going to be 4.6 in 2023. In fact, if we go back to the FedWatch tool, there's a section of the FedWatch tool which is called the dot plot. In fact, that ceiling has been lifted for 2023. What you have to remember is data is coming in all the time. So what they might say 2 or 3 months ago may be completely different to what they say now and what they'll say in 3 months' time. But what the markets, traders, you know, the market, they will listen out for things they want to hear. So when they hear the PCE is currently quite low, and they know the Fed like the PCE, it's, hey, it's off to the races, as it were. What he's also said, we are talking about a couple more rate hikes to achieve an appropriately restrictive stance. We are not very far from that level. Great. We all know when this awful interest rate increases are going to stop. I mean, how much more certainty do you want? Now, whether that actually happens because of data, who knows? But the market will hear what it wants to hear. I know he preceded that by saying we still have a lot, you know, a lot of work to do until we see inflation coming down. They don't listen. They don't hear that. They hear that. You know, they want to hear what they want to hear. And as traders, we have to pick out, you know, what is it that's going to move the market. Now, the one thing he did also mention, which isn't highlighted here in red, as it were, and that's about the labour market. We have NFP on Friday, so that clearly is going to give us some insight into you know, what the jobs market is at the moment. And you only have to read mainstream media to know that there have been some quite big layoffs certainly in the tech sector. I read yesterday that PayPal are getting rid of 7% of their workforce. Now, on the one hand, that is reflecting the current situation, you know, on the ground, as it were. Businesses are struggling, you know, things are slowing down. What you could also argue is that we are in earnings season, and obviously we've got earnings seasons for the rest of the year. And if there has been a slowdown, but you want to maintain your profitability, well, what's the first thing you do? You cut your workforce, because people are always, you know, they are the biggest, you know, they are expensive. People are expensive. And is that going to feed into unemployment? We'll find out on Friday, because one of the reasons given for maintaining quite an aggressive rates of increase on interest rates is that if you have strong employment and you also have a lot of job openings, well, people are going to be able to demand slightly higher wages or more money, and that is going to feed into the inflation. So there is this balancing act all the time that they have to try and achieve, as it were. And this is what he says: we do not yet see a deterioration in the labour market, although yesterday. By deterioration, he means, you know, a real downturn in the labour market. You also have to remember that part of the Fed's mandate is that they are responsible for full employment, as well as maintaining, you know, in interest rates. So he's kind of arguing against himself, as it were, there. But yesterday, another metric that they particularly like to look at is it's the employment cost index, and this is actually the cost to employers of employing people. That has moderated. I mean, very, very slightly, but it you know, is it another signal that wages are not going to run away, and, you know, people aren't going to demand big increases, as it were. And it's not just the wages, but it's actually the benefits that come with wages as well. So it's pulling together all these different elements of what the Fed sort of look at. What are the, you know, what are the metrics that they focus on? When these metrics are mentioned as we're having at the moment at the press conference, how is the market interpreting that? And as I said, it's always going to be the S&P, or it's going to be the SPY, or it's going to be the ES. Looking at it in multiple time frames, what have we got here? Well, That was a really nice candle. That was a nice candle, but you have got wicks to the top and the bottom. We've now got what looks like it's a sort of a shooting star. You're starting to see weakness because you've got wicks to the tops of the candle. It did go through the R3. Possibly it's going to come and retest. Volume is starting to, to drop away. It's not being supported by the kind of volume that we saw in the run-up. So maybe we are coming to a pause, and obviously he's going to come to a pause as well. And then what also happens is that once this is, he's finished speaking, then people will go away, and the kind of knee-jerk reaction we've seen will diminish, and there'll be a more, if you like, measured response to what he has actually said. You also have to remember that whenever he speaks, or any of the Fed members speak, they choose their words very, very carefully. They're not off the cuff remarks. They will have been, they will put in the keywords that they want to put in. They will also test the market often. They will say, they will make a comment or a statement that's been very carefully crafted just to see how the market reacts. Going back to the VIX here, what have we got? Well, the VIX is still falling. That it's certainly not still going higher, but it certainly hasn't fallen yet. It's found support, as I said, at this key R3 level. Just come back to where we are on the daily basis here. Where are we? Let's have a look. There we are. Where did we stop? Well, the outermost part of the volume point, where are we? 4127. I think I've got the daily chart on here. Let me just double check if I have. Nope, I haven't got it on this one. I must have it on another one. Let's have a look just to see where we are on the date. Here we are. In fact, I've got the weekly chart because it was actually really interesting. This is what I mean by this market doesn't really want to fall. Despite these pullbacks here, we have this is back in November. Look at the volume, but the key candles are these candles here, where okay, you had a fall off of volume here, but this is the holiday. This is Christmas. Let's move that over there. They found this really strong support at 3809. You've got wicks to the bottom of these candles, and we are talking, as I said, the holiday period. Then you have this little candle here, which has a decent amount of volume underneath it. Then the next one goes up. You've got a wick to this one as well. That was last week. Decent amount of volume underneath it. So it sort of it wants. As I'm trying to say, there's nothing in here to suggest that we are due an imminent dramatic reversal. What's interesting now on the weekly is we are coming to a key resistance level, and we know that because of this indicator I have here is our accumulation and distribution indicator. The thicker it is, you see it's dashed, it's quite thick. It means it's actually been tested 3 times. The more times it's tested, the more time it holds, but it's actually reversed off that in the past. So if it's going to pull back, it's going to pull back from here. I've also done a sort of kind of a trend line here that I've taken these points 1, 2, 3. We've got 4. We're actually broken through a trend line. If you use trend lines, they're great. There's been a lot of talk about the 200 moving average. That too, it's been up and tested it on the SPY, certainly has. It's poked through. Is it going to hold? It's going to run into this strong resistance here. So we'll have to wait and see. And as I said, there's we are in earnings season at the moment. So far, most companies, yes, they have reported a little bit of a slowdown, but what I'm trying to say is things are holding up. Are they going to hold up long enough to be able to get through this difficult patch and and carry on higher, much higher? Only time will tell. go back to the shorter time frames. Let's see, we're coming to the end. Is he coming to the end of his, let me see what time it is. Yeah, I think he's coming almost to the end of his presser anyway. Back to the 5-minute chart. Is it going to come back down here? Volume is falling away. Let's have a look here on this chart. Let's see here if it's going to carry on higher. Well, we'll just have to wait and see. So that's a little bit about the Fed. While Jay Powell was speaking, this is the hourly chart. We have this, I don't think I've got the volatility candle on here at the moment. This is the level, and it's also that key level that we have, very close to that level we have on the weekly chart. With regard to levels, I mean, part of volume price analysis, as you know, it's obviously price action volume, but support and resistance, how you determine those important levels of support and resistance is pretty much up to you. You can do them, you can draw these lines manually, you can have specialist indicators like we have, that we've developed, or you can use, people use moving averages, trend lines. It really doesn't matter, as long as you have on your chart key levels on different time frames, on the time frame that you trade, plus the time frame, the slower time frames, because the slower time frame levels, they do carry a lot of weight. Even, you know, the daily, the weekly, and sometimes the monthly, they are, you know, especially if they have been tested on a number of occasions. So just to recap, the Dove-Hawk scale, there's a lovely cheat sheet. I will put up the history of past Fed chair. It makes fascinating reading, and in fact, the next time I have one of these sessions, I'm actually going to pull it up, because it tells us in a way the dilemma that Powell and the Fed have at the moment. We've been in this situation before, and some Fed chair managed to get themselves out, others weren't so successful from the perspective of market returns, from tackling inflation. You know, everything works in cycles, and cycles repeat. They may not be identical, you know, that all the time, but they do repeat. And I often wonder, do these people actually go back and study the history of the cycles? We know Ben Bernanke was an expert on the Depression, which explains why he took the decisions that he took at the time of the 2008 great financial crisis. But as I said, I will keep that, I will bring it up, because there are some fascinating insights that also are very, very relative to what is going on at the moment. Well, clearly the market really likes what he's saying, because, you know, the ES is going up, the VIX is going down, and that's really, in a way, that's all we need to know. Let's go back to financial juice. Let's have a look. Will Fed chair call the markets dovish bluff? As there is a bit of poker playing going on here as well between the Fed and the markets, as it were. But we'll have to wait and see. And with regard to charts, you just have to look at the volume. If the volume is going in and is supportive of the price action, and maybe the market knows more than the Fed. Who knows? Let's have a look. We need to slow down. We do not use it in the late. Okay, he said that earlier. He said that again. There is a path without a significant economic downturn. You know, that's Fed nirvana, as it were. If you can get it down to 2% inflation without causing too much damage to the economy and certainly to the labour market, you know, it's off to the races, as it were. Unemployment will rise slightly. I can quote you here something that was said back here in the UK I think it was not the 70s, it might have been the 80s, that after the 87 crash, when asked about unemployment, because when you put up interest rates very aggressively to cope with inflation, employment suffers. People lose their jobs because companies can't afford to keep them on board. And the expression that was used is unemployment is a price worth paying to bring down inflation. Well, that's what that's what they have to hold on to, and always remember that they do have this second mandate, which is full employment. Right, okay. That's all I wanted to say. Thank you so much for listening. I hope you found what I have said useful. I'll be doing more and more of these videos, obviously looking at volume price analysis, but bringing in other elements as well to this, looking at other markets to see how they impact, what kind of, if there are a particular driver for the price action that we are seeing on the chart. So thank you so much for coming along, and I look forward to seeing you next time.